Hello, my friends. My name is Joseph. Today is April 9th. Happy Easter. And this is Markets Weekly. Today, we're going to talk about four things. First, we'll give a brief update on the regional bank situation, and I will suggest that the panic is over. Secondly, we'll go over Fed speak the past week. Third, we'll talk about the jobs situation in the US. And lastly, we'll talk about gold and the role of the US dollar. Now, first, as you know, the best way to think about the bank panic is to look at the Fed's weekly balance sheet. If a bank is in trouble, they borrow from the Fed. The Fed is their lender of last resort. Now, when I look at the most recent weekly Fed balance sheet, I see that the emergency lending that the Fed is offering to the banks is stable and declining. Even the FEMA repo facility, which was drawn on by an anonymous foreign central bank, is also declining. So all in all, that's exactly what we should be expecting. The authorities came out, took out the big guns, basically guaranteed all the deposits, and it's ebbing. Another data point that I like to look at is money market fund flows. So here you can see the asset flows of the government money market funds, which are money market funds that can only invest in safe assets like treasuries or a repo with the Fed or repo backed by treasuries, and prime funds, which are money market funds that can lend to banks. Now you'll note that over the past several months, there hasn't been all that much inflows into the government money market funds, even though they were offering relatively attractive yields for 4.5% and now almost 5%. Now, there wasn't a lot of people moving money into money market funds, even as rates were increasing. The fact is, most people are not super rate sensitive. But the moment here you see in March where investors began to realize that, maybe my bank could be in trouble, maybe my money could be gone, they began to panic and they moved a lot of money into the government money market funds. After all, government money market funds only invest in credit risk-free assets, so they're safer than leaving your money in a bank. Now, look at the prime funds. The prime funds, which because they can invest in riskier assets, have slightly higher yield, and they've been steadily drawing in some inflows over the past few months. Note the scale, though. The prime funds have much smaller than the government funds. The prime funds today have about $800 billion in assets, and the government funds about $4.5 trillion. Okay, so as the Fed has been raising rates, you see some people who are more interest rate sensitive move money into the prime funds, and so you see their assets gradually increase. But boom, at the same time that there's a banking panic, you see people moving money out of the prime funds. This is them acting the same way any bank depositor would. They're worried that the banks might go under, they might lose their money, so they're taking money out. So you had a steady amount of outflows out of the prime funds for a few weeks, and now, as of last week, you see inflows again. That's again a strong signal that depositors are becoming more comfortable with banks. Money is flowing back, and that suggests to me that panic is basically over. And when I look at aggregate data, it suggests to me that we had some impact on loan growth for the small banks, but not much on the big banks. So overall, the impact on the banking sector may not be very big. We'll see no more as things unfold over the coming months, but I suspect it was an overreaction. And now let's go to where the Fed is. Now, this is actually super important to me because from my perspective, the most important driver of assets is the Fed. When the Fed hikes, again, asset markets don't do well, stocks sell off, bonds sell off, and so forth. And when the Fed eases monetary policy, all financial assets do well. Now, we're at a point in time where there's a very big divergence between what the Fed says they're going to do and what the market is pricing in. Now, in this chart here, you see these dots. This is what the Fed is telling you that they're going to do in the coming months. This is based on the most recent March FOMC dot plot. And you can see that the Fed pretty clearly is trying to tell you that we're going to keep rates around 5% for the rest of the year, and next year we're going to step it down a little bit. That's their message. The market, though, is having none of it. The market is strangely fighting the Fed, as it's been doing for the past couple years. The market is pricing in pretty aggressive rate cuts throughout this year. almost actually 100 basis points. So that's a pretty big gap between what the market thinks the Fed will do and what the Fed tells you that it'll do. And over the past 2 years, the market has consistently been very wrong on this, but that's not always been the case. Sometimes the Fed changes their mind as well, most famously in January 2019. Now, we had some more insight into what's happening over the past week with a couple of Fed speakers. Fed President Loretta Mester and Fed President James Bullard, both of who are not voting members on the FOMC and not terribly important, but both came out with pretty consistent messages. They both said that, I still believe that rates should be around 5% or higher and should stay there. So no one is talking about a rate cut. Furthermore, when James Bullard was asked, the market is very different from what you're saying, he was like, yeah, the market should listen to me. It was kind of a joke. But I actually think that they are going to be right again. And this has tremendous impacts on entire asset prices. Because when you look across all the assets, it's really just one big trade. So the market is pricing in aggressive rate cuts. So you see bond yields go down, you see the dollar sell off, you see precious metals go up in price. And of course, you see the equity market being bid. It's just all one big trade based on future Fed rate cuts. And so if that were to reverse, all those trades will probably reverse as well. There's a couple of narratives in the market as to why we could have rate cuts later in the year. One, of course, is the concerns over financial stability. There's been a perception that there's a trade-off between inflation and financial stability, where the more the Fed hikes, yes, you can get inflation down, but then you threaten financial stability, and then they would point towards what happened with Silicon Valley Bank. Fed President Mester addressed that directly and says she doesn't think there's a trade-off at all. More basically, she said that, well, if you have high inflation, that causes financial stability in of itself. Another way you can think about this is if inflation stays high at, say, 5% going forward, well, all those bonds and financial assets, all those bonds will sell off. That will cause more problems with people who hold a lot of bonds. It's going to cause financial stability and so forth. So that what's perceived as a trade-off is not really the case. And again, she reiterated her belief that rates should be above 5% and stay there. The other narrative in the market for rate cuts is that, well, inflation is coming down, it's going to be under control, and by the end of the year, the Fed will cut rates because inflation is under control. And of course, they would note that the labor market appears to be slowing. Over the past few months, Fed has been very clear that they're looking at wage growth very closely because wage growth is a very major determinant to wages, to inflation, because wages feed into everything. Now let's first look at the inflation situation, actually. So we have CPI next week, so we'll figure out what that is going to be. The expectation is that it stays comfortably above the Fed's target range. But what I'm going to show you right now here is a chart of the core PCE inflation. PCE is the Fed's preferred inflation gauge. Now, Michael Ashton of Inflation Guy, that's his handle, he specializes in inflation, made a really good observation. And that is that core inflation is really sticky and not really mean reverting. And he would point out that back then in the 2008 financial crises, when the world was really imploding, even back then you had core PCE go negative a little bit, and then immediately it would go back. Even when the economy was very weak, even when unemployment was very high, you'd had core PCE basically bounce back to around 2% and just stay there. So inflation, core inflation, is not something that magically reverts to 2% or anything like that. It's really sticky. Even when you have these huge negative exogenous events, it stays around 2%. And in the same way, when you see core PC rise to around 5% today, that there's good reason that you would expect that to be sticky as well, because that seems to be how this works. So historically, the market thinking that inflation will come down very quickly and then the Fed to start cutting rates, that's not really something that's supported by the historical data. So, and of course, related to inflation is what's happening with the jobs market. So on Friday we had a jobs print. It was fine actually. It wasn't super hot. It wasn't really below expectations. It was basically spot on. Now, the economy is creating jobs at a slower rate than it did in the past, and that's to be expected. I mean, eventually you're going to run out of people to hire, and obviously we've been in this economic cycle for some time, and so some slowing would be expected, especially as the Fed is let's say hiking rates. Now, when I look at the market and its reaction to the jobs data, I can tell that it's both very focused on it and very biased towards any sign of potential weakness. Now, I remember just a few days ago when we had the JOLTS data. The JOLTS is actually, as far as employment data goes, it's not like Tier A data. It's something, but it's not Tier A data. So we had the JOLTS data show that jobs openings dropped below 10 million for the first time in a long time, and then suddenly the market began to aggressively price in monetary easing. But that's really lacking context. So here you have a graph of the JOLTS data time series. And you can see, yes, it's definitely come down to below 10 million job openings. But then you just have to zoom out a little bit and you can see that 10 million is far, far above the pre-pandemic typical level. It looks like really you just vaulted up to Mount Everest and came down a little bit. So to say that the job market is slowing, definitely true, but it's also super true that the job market remains very strong, which is what was emphasized in President Bullard's presentation he also gave last week. Now, again, to top that off, we can again look at wage growth. Again, wage growth is super important because wages are a very big input to vast amounts of businesses, especially services-oriented businesses. And this chart again shows that wage growth still remains comfortably at multi-decade highs. We're going to probably get new numbers for this next week, but as of February, wage growth was about 6%, and that is not consistent with 2% inflation. So, in summary, the labor market is slowing as expected, and that is exactly according to the Fed's forecast. So things are evolving according to their forecast, and based on their forecast, they're saying that they're going to hold rates higher for longer. So we'll see how this evolves. I continue to think that the market is making a mistake by fighting the Fed. But in line with this huge trade of rate cuts, we see that something kind of is quietly happening in the background, and that's gold. So gold is just a stone's throw away from its all-time highs. And you can see in this chart there that it's basically just, quietly without much fanfare surging. Now there's a couple narratives to this. And when you think about gold price, it's not easy to find a concise driver. Sometimes people will point towards negative real interest rates as driving gold higher. Other times people will point towards inflation, but of course that hasn't really worked out the past couple years. We can talk about geopolitical stress. We definitely have that here with conflict in Europe and potentially in East Asia. And of course, we can talk about the diversification out of the dollar. So some other news this past week was we seem to have more and more people making noises of moving away from the dollar. We have people in the Middle East and, of course, in Russia thinking that, hey, maybe we'll use another currency to transact instead of using the dollar. That's definitely happening. And to be perfectly clear, reserve currencies don't last forever. They always change. But when you look at the dollar, though, I think it's pretty clear that we are many, many years away from the dollar losing its reserve currency status. Just some easy numbers can show you how dominant the dollar is. Here's some work from the Bank of International Settlements, and it'll show you that basically when you look at something like FX transaction volume, it's overwhelmingly dollar denominated. FX trade is basically selling one foreign currency against a dollar. that's really all it is. It's the dollar is just completely dominant when you're looking at foreign exchange. Or you can look at trade invoicing. So globally, about 50% of all international trade is invoiced in dollars. So if you're a Japanese company buying from an Indonesian company, odds are you're going to be paying in dollars. So the US is actually not super active in international trade. So when you're talking about international trade being invoiced in dollars, it's mostly foreigners buying from other foreigners and invoicing in dollars. Any other financial metric would give you the same answer. So if you are someone who is abroad issuing, let's say, trying to borrow in foreign currency, most of the time you're going to be issuing in dollars. Same as if you are a foreign company borrowing from a bank in a cross-border transaction, most of the time that's going to be in dollars. So the dollar currencies are kind of like they're kind of like a network effect. So if you are someone who has a credit card, you want to use MasterCard or Visa because MasterCard and Visa have wide networks and they're accepted everywhere. Now, smaller networks like Discover may be very nice and may be very well run, but at the end of the day, you need a network that you can use everywhere in the world. Those network effects are very strong and they're very hard to change. And so it's not surprising that since everyone uses dollars, it's not easy for anyone to build a competitor. So it's really hard to see the dollar's dominance being challenged at all in the next several years. That being said, you can still have movements towards that. And one of the movements towards that is not just in finding alternative payment mechanisms, but also diversifying your foreign reserves. So if you're a country like China, who has trillions of foreign reserves, right now you hold probably $2 trillion. It's a state secret, but I think estimates are around $2 trillion, maybe more, of US dollars as your foreign reserves. You also know that you're not good friends with the US. And you also know that when push comes to shove, the US could simply freeze out your foreign reserves as they did to Russia. So obviously many countries in the world, just prudent risk management, they have to manage their foreign reserves and diversify them a bit out of the dollar. And that is probably part of the reason why you see gold steadily rallying. The interest rate cuts are a big part. Geopolitical risk is as well. But if you have more of a movement, not just by very wealthy Middle Eastern countries, by the Chinese and by everyone in the world who doesn't really like the US, they're going to have to buy some gold just to protect themselves. So I can see this being something that is going to gradually play out over the coming years. That being said, it's probably going to be a bumpy ride because inflation could still be persistent, and so if market prices out those rate cuts, well, the dollar is going to strengthen again, and this is probably going to take a hit. But that being said, it seems like over the coming years, there's still some good fundamental story for it. Okay, so that's all for this week. Next week, the big thing that we're going to focus on is CPI. Again, everything is driven by central bank actions. The Fed tells you that they care a lot about inflation, so everyone is watching inflation. I'm going to be on a Spaces with Unusual Wells talking about it in the morning, and that will be recorded as well. So I'll talk to you guys next week, and thanks so much for tuning in.